Welcome to today's episode, where we explore one of the most misunderstood realities of the modern world, the invisible forces that shape global markets. We're not talking about politicians, presidents, or CEOs. We're talking about something deeper. Sovereign wealth funds, central banks, hedge funds, and multinational corporations, the real architects behind global financial power. These actors collectively manage tens of trillions of dollars, influence regulatory frameworks, drive monetary conditions, and shape the flow of international capital. Yet most people barely know they exist. Today, we're going to change that.
Exactly. What makes these powers unseen isn't secrecy. It's scale, complexity, and their ability to act across borders. They don't control markets with force. They steer them with liquidity, leverage, policy, and strategy. As the file we're analyzing states clearly, control is a distributed phenomenon within a complex, multipolar system. So today, we'll break down how each pillar operates and how they quietly shape your job, your savings, your investments, and the future of global competition.
Let's start with the first silent giant, sovereign wealth funds, or SWFs. These are state-owned mega-investors managing national wealth. By 2025, they control over $13 trillion in assets, more than the GDP of China. But their real power goes beyond size.
Right. They represent the fusion of finance and statecraft. Some SWFs exist for stabilization, like Russia's oil fund. Others focus on generational wealth, like Norway's government pension fund. And then there are strategic development SWFs, which invest to shape national industries, secure resources, or expand geopolitical influence. The file notes that SDSWFs can invest up to 50% of their assets domestically, shaping national development trajectories.
But with power comes suspicion. Many SWFs remain opaque, and according to the document, the 7 least transparent funds account for nearly half of all holdings.
Exactly. That's why the Santiago principles exist. But adherence is voluntary, and geopolitical motives often outweigh transparency. And now there's a new shift: integration of UN Sustainable Development Goals. 2/3 of SWFs align with SDGs, investing heavily in clean energy, healthcare, and strategic tech. Saudi Arabia's PIF acquiring Val-based metals for $2.8 billion is a clear example.
If SWFs are strategic investors, central banks are the architects of the financial environment itself.
Absolutely. As the document says, central banks shape monetary policy and control the flow of liquidity with profound consequences. Their tools include interest rate policy, open market operations, quantitative easing, macroprudential regulation, and swap lines.
The most powerful of them all? The U.S. Federal Reserve.
Right. A Fed rate hike instantly tightens global credit. A Fed rate cut sparks global risk-on behavior. The document explains, a contradictory Fed shock widens corporate spreads in Europe as much as in the U.S. ECB policy barely affects U.S. markets. Pure monetary asymmetry.
And during crises, central banks coordinate, like the global swap lines in March 2020 that saved the international dollar system.
And now we're in a new era: quantitative tightening. The Fed shrunk its balance sheet from 9T to 6.6T before halting QT in late 2025 to stabilize liquidity. This matters because central banks aren't just regulators, they're the liquidity engines of the entire global economy.
Now let's talk about the most dynamic and dangerous pillar: hedge funds.
As of 2025, hedge funds manage about $5 trillion, but their gross notional exposure exceeds $33 trillion due to leverage. Some funds operate at 18-to-1 leverage. Quant funds can hit 40-to-1. And they're deeply interconnected with banks via repo markets and prime brokers. Exactly. Hedge funds supply liquidity during market stress, like in March 2020 when they bought massive amounts of corporate bonds while others were panic selling. But they can also trigger systemic risk. Examples: LTCM collapse 1998, 2020 Treasury market disruption. Regulators now include hedge fund failure scenarios in bank stress tests. And beyond markets, hedge funds are reshaping corporate governance. Right, shareholder activism, Elliott, TCI, Value Act, can push companies to restructure, cut costs, or even replace leadership. Activism leads to short-term stock boosts, but long-term impacts are mixed. Some studies show improvements, others show reduced R&D and job losses. And today's funds are tech arms races: AI, machine learning, predictive models, billions invested in algorithms.
Now let's talk about the actors everyone knows, but almost no one understands: multinational corporations.
Exactly. MNCs are the real engines of globalization. Half of all U.S. public firms, over 50% of exports, 40% of imports. They run vast supply chains, like the iPhone example in the file.
But their influence isn't just economic, it's political.
Correct. Becoming an MNC increases lobbying spending by 50%. They shape trade laws, tax codes, and even immigration policy. They prefer supranational forums like WTO because they exert more influence there.
And they dominate ESG and global standards setting.
Right. Again, this is private global governance. Environmental standards, labor rules, sustainability, increasingly defined not by governments, but by companies.
And investment patterns shift with geopolitics.
Exactly. Since 2022, FDI has pivoted to future-shaping industries: semiconductors, EV batteries, data centers, AI infrastructure. China receives 70% less Western FDI while increasing investment in Africa and Latin America.
This brings us to the final, and most important part: the system itself.
Yes, no pillar acts alone. The file explains it perfectly. Central banks create liquidity. Hedge funds exploit liquidity. SWFs allocate patient capital shaped by macro conditions. MNCs generate the cash flows and FDI that fuel global markets. It's a giant feedback loop. A shock in one sector spreads everywhere. Examples: 2008, COVID-19, US-China decoupling, all driven by interactions between these pillars.
And regulators are trying to keep up.
Yes, but global regulation is fragmented. SEC, CFTC, OCC in the US, FSB, Basel Committee, IISCO internationally. They try to stabilize a system built on volatility and power asymmetry. So who controls global markets? No one and everyone. Power lies in the interactions of these four forces.